Nareg, how are you, man?
Hey, Brandon, doing good. How are you?
Good. Did I get your name right?
Exactly. Yeah, Nareg, you got it perfectly right.
Thank goodness, man. Well, listen, I was really excited to talk to you. You and I met on Twitter. I got back on Twitter a few months ago. I guess really when Elon came back, just to see what it was about. I had it to be completely candid on automated posting for probably 9 years, and I managed to get some followers, but then I was back in the entrepreneur sort of startup community, I guess, by the algorithm's decision, and stumbled upon you in some threads. And then I looked you up, and I was really excited and refreshed to see a lawyer for startups that was doing something completely transparent and upfront and aligned with what startups can understand and actually handle cost wise. And then I looked, and I think you have your law degree from UCLA.
Mhm.
You worked at Cooley, which is arguably that I know there's a lot of firms, and there's like Greenberg Trierigg and some other big national firms in the startup maybe space, but Cooley is really ahead of the game, especially in the Valley and in Northern Virginia, where I first met Cooley and Mike Lincoln. And then it looks like you branched out on your own. So, there's a lot of people on Twitter that you run into that have claimed to be pros, but then when you dig into it, aren't quite pros. And you happen to be one. So I was really excited. Thanks for joining today.
Yeah, of course. I'm excited to be here. To be honest, probably my first podcast ever, and exciting. A little nervous. Lawyers love talking, but we also hate being recorded, so it's a lovely relationship there. But I'm excited.
Well, yeah. Well, the good news is there's a lawyer on the show. So if we go over the line on anything, it'll be covered in some way because you'll make some disclosure, right? Um,
Exactly.
But I want to jump right into it and just start off with what you're seeing in the startup space these days. I am a little skewed. The startup that I have now is self funded and bootstrapped, and my I still do angel investing. So I see deals that may already have a lead investor with some terms and things like that. And
Hmm.
then, really, I think, Narig, the only place that there's like a two-way conversation happening with some version of VCs I see is on Twitter, and I hear these crazy things that I just can't imagine was true. I got into a I'm not gonna mention the person's name because she's here in the valley, but got into this discussion 2 weeks ago on a Friday afternoon. I caught this tweet that said that current VCs don't do follow-on investments. And I was a VC. I've never heard of this in any major firm that they don't design their fund to have follow-on investments. And this person went on to tell me she used Sequoia as the example of how Sequoia didn't make necessarily a smart decision on doing a follow-up. I don't know if it was Airbnb or whatever they did, because the return wasn't as high. And I said, well, one, it was pretty much reduced risk at a 10x return. So I
Hmm.
think any VC out there who's not Sequoia, Kleiner, like in the top would take that return. I'd raise my hand for a 10x return. And second of all, if investors don't follow on, it is an indication potentially to the new investors that they don't believe. And, I made the case that, like, well, what would I say? Well, I've already made my big bet. This thing's on a trajectory. I'm going to go back and try to get my 100 or 1000x, but you invest in this one, and I'll see you later. Like, it just that I mean, that's crazy. That's a little crazy going thought going on there, right? Like, that's
Yeah,
not really how it works.
yeah. The latter point you made is actually a great one. The signal it sends to other investors, they're going to ask. They they are going to ask, why did Sequoia lead your first round, your seed round, but is not investing in your A round or A to B, or why is Andreessen why they lead such a big A round, but now they're not investing in the B. Um, they're going to have to explain that, and that almost only happens if they lose trust in the founder or see the vision going differently than how they plan. So to say that there are no follow-ons, no, that's not what I'm seeing. If there is a good investment, they are going to put in more money because, like you said, a 10x, they will all take a 10x. 10x on top of the 100x from their earlier investment is an amazing return. So it's better than going fishing or hunting for the next risky investment.
Yeah, I just didn't. And I can understand, but even I was a member of some used to be on the East Coast an angel group. Even angel investors are going to try to keep putting money in as not just, I mean, as a signal, but also as a return at a reduced risk as the company gets older. And I guess I ask as a founder, why would I want an investor who's going to put one investment in and then ride it? I think this person used Y Combinator as an example, and my understanding of Y Combinator, and it could have changed, is Y Combinator still would ante up in future rounds if they thought they were going to get a return, and if they didn't, that's like five standard deviations from the norm that everybody understands. It's Y Combinator, like but that's just not how you would ever do that. I would never take in money from an investor necessarily that upfront told me they weren't going to continue to invest, because you're basically shooting yourself in the foot. So you're not seeing that in general,
No,
though.
no, I mean with Y Combinator, their model is more of a accelerator where they really are hands-on at the beginning and they'll take a percentage at that point, and they will follow on if the check sizes don't get too big, but they are not investing in Series B, C, or any of the later growth stages. So if you don't see that often, that's normal from Y Combinator. But the angels, a lot of them are excited and want to keep investing, but sometimes the minimum check size gets too big for them. So that's why you might not see an angel in the A or B round. You might see them with a pre-seed safe and then come in at the seed with your minimum check size that you're looking for, and then from that point forward, it's mostly just institutional investors.
Yeah, and I think that's expected. I mean, an institutional investor isn't going to necessarily beat up on an angel investor who just it's out of their range to write
Exactly.
$1 million check. I mean, if they're a billionaire or something, maybe there's some criticism there, but I think it's expected. What other terms are you seeing out there as it relates? Do you mostly do tech?
Yeah, so when I was at Cooley, we did a full range of industries. I was part of the blockchain and tokenization group just because of my passion for the Web3 space. So it was a split between traditional tech, some life sciences, and also the Web3, but mainly Web3 and tech. The terms, it's interesting. People talk about all the different terms that may come into play because of the macro environment and potential down rounds and things like that. But more of what I've been seeing is that volume of deals and valuations are just down across the board. And that's supported by the data that Cooley puts out, that PitchBook puts out. And Cooley has a quarterly like venture financing report that they put out that's very, very useful coming from them. And the terms like play to play or participating liquidation preferences haven't made their way into deals yet. So it's still a very small minority of deals. I haven't run across it on the deals I'm working on now. It really is more of the, we want to lower valuation, we want to make a percentage of the company up front, we want more protective provisions, we want protection on any exits that aren't at a minimum multiple that we're looking for. So those terms are more prevalent and they do influence decision making on the eventual exit or any operations, but it's not as consequential as like a pay to play or a liquidation preference that's also participating. And I'm happy to explain that if you think could be
Yeah, I
helpful
think
to the
that'd be
people listening.
I think it would be definitely very helpful, because a lot of the times I don't think people understand how the terms actually translate into the cap table
Hmm.
on an exit opportunity, or even in an opportunity to acquire the company and the discussion that goes around it. So I don't know where we start, but maybe participation. So are you seeing participating preferred terms?
I'm not. It's still very uncommon. So liquidation preference is basically protection for these new investors who come in from the downside. So if the company were to one day exit or sell or for less than what the company was valued at during the raise, and a founder might think, hey, these guys are going to share the pain with me, and we're all, on a pro rata basis, going to lose some money on what we invested in here. But that's not the case. Investors get a liquidation preference, which means they are pretty much senior to the common stockholders, and they get whatever they invested into the company back first before anyone else gets anything else. That's a non-participation liquidation preference. So they would only get that if the company was to sell for less than, what they're valued at before. If they are participating, that means they get what they put in first, always, and then they get to share again with the common stockholders on whatever is remaining. So if you get a participating liquidation preference, even if you sell for a lot more than what you're valued at, your preferred stock investors are always going to get the money they put in back first, and then they're going to participate again with you on getting the pro rata share of the entire deal. So it's kind of like a double dipping when it's a participating liquidation preference. Sometimes Again, haven't seen it yet, but usually it's 1x. So sometimes you might even get a 2x where they get double their money back first before anyone at the company or the employees or anything get anything back from the deal. So as, the macro environment uh, for venture capital gets worse and worse, basically, there's more leverage for investors to negotiate for these terms. Um, I think I think they do have the leverage to ask for it, but I think with venture capital and startups and founders, there's so much of a relationship, just a people's relationship game where people don't like to be taken advantage of, and they may feel like those terms are just pushing it a little bit too far. So maybe that's why. That's just the feeling I get.
Let's just do a quick. You can tell me if the math is right here based on the the down round non-participating preferred makes sense. So they're going if you invested at 10 million, just say it's post money,
Hmm.
they sell for 5, the investor invested 2, they're going to get their 2 back, and then everyone is going to participate in that 3,
Hmm.
including the investor who would theoretically own 20%. Just doing simple math here.
Yeah.
On the upside, if an investor invested 2 million, you got a $10 million post, and it sells for 20 million at a 1x participating preferred, they're going to get their $2 million back, which now means everybody's going to share in $18 million at their percentages. So
Hmm.
that's a participating preferred. I'm actually glad to hear that the participating preferred hasn't come back yet. Back when I did my first deal with Greenberg Tririg in 1998 or 1999, participating preferred was pretty standard. Or I'll say they could get away with it.
Hmm.
There just wasn't as we weren't as connected, I think, online as in being able to talk to one another. In Northern Virginia, there was like Netpreneur, which was the first online forum. But so that's good. Good to hear. What other are they getting? I'm sort of. I'm glad you started simple. We'll sort of move into complications. Are they also getting a dividend? Is a dividend pretty standard right now, or are they not getting any dividends, whether it's participating or non-participating?
Yeah. So dividends is one of those terms that has been showing its head more, typically around 6 or to 8%. So how that works is the company won't be actually paying out those dividends until an exit, but it does accumulate. So every year, 6% of whatever price per share that they paid in at will accumulate on top of their liquidation preference. So once they exit, they get whatever they put in plus any, it's basically an interest on the money that they put in, which is funny because you would think on an equity investment, why are you getting interest? Just do debt, but it's just leverage that these investors have now with the market and how it is right now. They say there's, plenty of, funds out there. Funds have raised a ton of money, but they're not really deploying it. I think most VCs are, again, I don't have too much evidence to back this, but I think they're just tired from the last couple of years and also waiting to see where the market really bottoms out. It's hard to, catch the exact bottom, so they're just waiting to see once the market starts turning up again, that's when they'll probably start increasing activity.
And look, if you're in their shoes, you're going to ride the market and get the best deal you can, because I think that entrepreneurs don't always understand venture capital's business model is they have bosses called limited partners, and they've got to return the money at the highest return in their model, depending on what level firm you're at, whether you're doing more startups or more CD rounds or more uh, pre-IPO rounds. They're still really in the early stages betting that one of the 10 is going to make their return for their fund. And it's a hard model, especially if you're collecting a 2% management fee on $100 million over 10 years. You're really only investing $80 million and you don't get any comp above 100. So it's not as easy as it, I think, appears sometimes. So I don't like it as an entrepreneur, Nareg, and I don't think the rest of anybody else does. But by the same token, if that's what they can get, the interest on the equity always rubbed me the wrong way, just because of what you said. Like, it's equity. If it was like, then just give me the loan. I
Yeah.
mean, because just give me the loan, just give me what your dividend your rate is, add 4 or 5% for the risk, and I'll take the loan versus the equity, because you pay net, you're gonna, if you get an exit, you're gonna make more money.
Yeah,
But
exactly. It's funny, but that's how things work. And yeah, on the business model for VCs, I think people just hear about the home runs so much. You don't hear about all the flameouts that don't work out. So, you hear about the Coinbase, Airbnb, DoorDash, et cetera, but you don't hear about the nine other investments that didn't work out. So,
yeah,
um,
we can't even name them. Well, I guess we could FTX or some other ones.
yeah.
If we go down that route. What terms are you seeing? Are people still using the safe notes for rounds up to, I guess, $3 or $4 million, or has that changed?
No, that's still around. Safes are still predominantly how pre-seed rounds are held. So most folks will get a group of angel investors or family and friends who invest through a safe. So safes are great because at such an early stage, you don't need to price or value your company yet. You kind of kick the can down the road, get some money to get you going, and go out to have a venture capitalist kind of actually value the company and price it. And those folks will get some sort of discount, whether it's a percentage discount or a valuation cap, and their safe will convert into preferred stock. Um, what I've been seeing more and more now after the market kind of downturn is that founders are just stacking safe rounds on top of each other. And I see a lot of talk about it on Twitter where there's no consequences. It's great. You save on legal fees, you save on dealing with, active investors that kind of want information rights and things like that. But they're also kind of giving up a lot of equity because those safes do not get diluted when you keep stacking it on top of each other. But once you convert a round of safes in a price round, the next price round or next round of safes that you raise, you guys share all the dilution together instead of the founders taking like the big hit at one like priced round event. So there is that. And it also, another thing is if you stack too many safes and the dollar value just gets too big, a lead investor wants kind of majority control of the preferred stock at those early stages. It makes it a lot more difficult. They'll have to cut a much larger check to kind of command the voting power of the preferred stock once it converts. Um, then you have to separate it into different classes of preferred stock and kind of giving certain rights to this preferred stockholders class and changing it up for the safe holders who converted. So it kind of can come back to haunt you by making the deal more complex once you eventually do convert.
Are they doing? They're just doing the safes because they don't want to price the round and they need the money because they're squeezed. Is that basically what's happening?
Yeah, basically, I mean, it sounds nice, right? I can raise 3 million off this simple, super simple agreement, and that'll give me runway for 2 to 3 years. And then when 2 to 3 years passes, I'll do another 3 million again on the safe, and you kind of can stack it up for a few years there. But eventually, that dilution hit is going to be a little bit painful, and then the complexity of finding a lead investor who's willing to cut a check size that big to kind of take the voting power control might be an issue.
Are the, with that, are they doing more, or you're seeing more discounts or caps? Because rarely would you get both, right? It's
Mhm.
either, they're going to either say it's a $15 million cap or it's 20% discount on whatever the valuation is.
Yeah, it's sort of 50-50, I think, in my opinion. I see a lot of 20% discounts, which I feel like is becoming kind of the market standard. Valuation caps range a lot more depending on what the founder can negotiate with their angels. I see 7.5 million, 8 million, 9 million valuation caps. So it's pretty split. It just kind of depends how the founder, wants to set it up. The valuation caps gives a little more certainty because you can kind of calculate how much is going to end up with your safe holders after a round, but the discount is just kind of based on whatever valuation you can get at the price time.
The on the oh, I was thinking of something as it'll come back to me, Nareg. I have so many questions going through my head for you on basically like where the market is today, and it was on, just to add some context for listeners. When you say valuation caps at 7.5 to 9 ish, those are basically pre-revenue companies. Ideas may have a beta product already or may not. Or
Hmm.
can you comment a little bit on what you're seeing there? I feel like ideas aren't getting funded anymore. Some VCs or some angels will say, I fund ideas, but they're really looking for some version of a product or service that may not have. There's a lot of debate about what product market fit is. I mean, to me, it's a repeatable sales process that people are buying,
Hmm.
that you can hire a VP of sales and they can replicate that on a regular basis. And that is hard to find. So, where in that sort of company profile are you seeing that? And comment maybe on first time founders are probably going to be lower, I would think, than somebody who may have an exit, may have two, may have a bunch of failures, which still counts. At least here on the West Coast, I think it's maybe bled over more into the East Coast,
Hmm.
but I still think they're way more conservative.
Yeah, that's a good question. Again, you don't see it as much in those terms that we were talking about earlier, but you do see what stage companies need to be at to raise any type of money from an institutional investor. And when I started in 2019 through halfway through 2022, if you had a great idea, you might be able to raise on like a $15 million post money valuation at a seed stage. So that was
As
not
a first-time founder?
it was the first time if you had a really good idea, if you had credentials, if you went to an Ivy League, yeah, maybe have an MBA, maybe worked at a startup for a while. Your
Mhm.
idea was valued very, very highly before you even had any operations at all. Now, a lot of people are raising pre-seed money from angel investors and using a year or two to build their MVP, find product market fit, get some revenue, maybe a few pilot agreements with customers and things like that before VCs will even take a look at them. I mean, VCs that I've even worked with in the past that were funding these idea stage founders are now telling me, hey, if you find any, um, positive revenue companies, startups that are looking to raise their seed round, please send them my way. It's no longer send me the good ideas. It's send me the good ideas that are making some money. So it's interesting how that's shifted so much. And like you said, exceptions are made for repeat founders. If you were employee number 4 at something like Snowflake or like a DoorDash or Uber, and then you start your next venture, a lot of these rules are thrown out the window. They will make exceptions for you. So that's also interesting to see.
Yeah, it's definitely changed. I will say that I'm catching myself here because I make the face like, "Oh, 15 million. Wow, that's a lot."
Mhm.
But I just had a discussion with someone the other day about these. It looks like to me, do you feel like there's this, and it could just be hanging out on Twitter recently and seeing more of them. I mean, they could be on Angel List or somewhere else. I don't know, or in get-togethers that maybe are coming back now post COVID. But I feel like there's a huge influx of these micro investors, and I can't get my head around. They talk like they're a large investor, but it's very clear they're writing checks that are like $10,000, which I'm not diminishing. I'm just saying that is a really small investment compared to an A round higher end firm, right? Like,
Mhm.
and it just doesn't, not just Sand Hill Road. I mean, there's firms all over the country now, but a firm that's reputable, sort of in that top cohort regularly of all VC funds, like it just seems so junior, and the discussions that they're having around this, and some founders spending an enormous amount of time trying to get these checks that, to be honest, there you can not raise enough money and kill your startup.
Yeah,
I
that
mean, are you seeing some of that out there?
yeah, micro investors are much, much more popular now. Micro funds in general are popping up. The venture studio model is becoming much more popular too, which is interesting. But I think the reason why you see these discussions on Twitter a lot more about these folks who are cutting these small checks, but talking a lot about being so active with their founders and things like that is because of how extended the pre-seed stage has become. So if they cut a $10,000 check on day one, they're also acting like an advisor to the company until they get an institutional investor on board who will kind of take over that role. So um, I think while the market was super hot, angels were also taking a bigger like backseat role and not really being expected to provide any guidance or advice. But now, because the pre-seed stage is so long, they are asked you're asked more of you as an investor than you were before, which is it's actually pretty funny. You would think it would be the opposite, but it's not.
Well, I don't understand how the math works for their time. I mean, and I don't like these micro funds. I mean, I some of them have, I get the decks for, and it's like $3 million or something, and I'm just thinking like, how are you even pulling a management fee off the? My question is, what's your day job to pay your mortgage? Like, I mean, the math doesn't work, nor does it work for your time. If even if you're going to write 25 or $50,000 checks out of that thing, and you're going to spend time with all of these startups that arguably are in the earliest stages of forming, and some of these founders haven't done this before. I mean, I don't know, Nareg. It just feels like the math. I could be off, but the math doesn't add up on my whiteboard when I add up the math and how many hours in a day.
Yeah, I've heard of these I'll explain why I think this is how it is, but I've seen microfunds who take of actually very, very small or 0% management fee sometimes. And because they've had some success in the past, their startup and they can fund themselves, their living costs and, expenses for an office and everything. I think they're using that opportunity to prove themselves and prove a track record so that the second fund and third fund can get bigger and bigger and they can charge a management fee on that because these VCs are competing with each other for the LPs too. I mean, there is a lot of money out there, but at the end of the day, everyone who is into venture capital investing as an LP would love to put money with Andreessen, would love to put money in Sequoia because they get some of the best deal flow just because of their reputation. Whereas, why should I give this small micro fund, unproven manager a 500K check on a $3 million fund? So I think that's how they're trying to entice LPs to give them a shot. So that might be it.
Yeah, I think you're right. I mean, I work for a fund. Our first fund at that fund was 27 million, but it was just not. It wasn't three, um, and I. It seems like a lot of work. And if, like you said, if someone's younger and wants to try to make that happen, you can definitely spray the checks. But there's been some models out there. I think the earliest one was probably 500 startups when they did their model, and the math doesn't always work out, on the returns necessarily. And I look at it really now that I do angel investing, but I'm more of an entrepreneur and I like that side of the table. I think my investing comes from being able to actually add some value to make sure that the investment's worth something, versus being a better. And I don't think there's a right or wrong. I think being a better, you can make a lot of money just placing bets
Oh
on,
yeah.
studying the founder, the team, the market, the product. Do they have enough money? Writing a check and letting it go. I don't know that one is better than the other. I think it's whatever your model and you're comfortable with. But I always worry that the founders, and you've seen this at much more volume than I have, especially working at Cooley and now where you are now with your firm, is founders think that the check is the answer to their current problem of product market fit. Right? And you can't buy product market fit.
Yeah, I think putting in that time and effort to do the research, find the product market fit is what a lot of founders are kind of having a tough lesson with now. I've had clients and some potential clients that I have to talk to, and they're debating whether they should just stop pursuing this business idea because they're not getting any interest from VCs or they're just having trouble finding profitable clients or customers for their product. And I have a kind of a heart to heart, tough love moment where it's like, founders who have made it through the tough times through the last recession were doing crazy things to find their product market fit. They were going to the mall and just asking people questions. If the DoorDash story always stuck to me, where they literally spend time in their afternoons, evenings, just going to restaurants and bakeries and asking like, hey, why don't you offer delivery? Or like, would you want to offer delivery? Or what's something I can make your life easier with? Like, what's a problem that you're having? And they didn't even have the concrete idea yet. They're really just trying to solve a pain point like that. And I think a lot of founders might be trying to do the reverse. They're kind of creating the problem and and then going like or building the product and imagining the problem instead of actually asking to find out what it is.
Oh, I think you're right. And I made the mistake of building a solution and looking for a problem to
Exactly.
solve.
Yeah, that's the better way
And
of saying it.
and it is a problem. We managed to make it work in that company because we went into the government sector that is completely different, a huge risk if you make that move because of government contracts and length of time and just everything that was included, including clearances and things like that, if you work on classified stuff. I mean, it is a huge bet, and we did make that bet, and it did work. It didn't pay off huge. That company's still around. Long term, it could work. I saw it as, well, if we go through all of that pain, the moat or the barrier is that anyone we see coming is can't in general you can't cheat those certifications and
Hmm.
qualification, like you can't cheat them. I mean, even when a new White House comes in, it still takes 18 months to get a clearance or something, right? Like
Yeah.
it's very hard to do that. So that was just a big bet. But the ones that build it and then look for it, I think the other thing, Oregon, maybe you can comment on this in your discussions, is people think that raising the money is the validation. And if VCs in the early stages, in general, only hit 1 in 10, then maybe a no is better than a yes, right?
But
Because 90% of the time they're wrong.
yeah, that's a good point. I don't think the money is the validation. The money might be validation that you have the potential to do something, but it might not be that first idea that you came up with, which is maybe why a lot of startups pivot even after a Series C or a Series A. So I think people mistake the check with validating their idea rather than validating maybe that person's belief in you, which is very, very different and could lead to, your product not being successful is not always a reflection on yourself. You might be a super intelligent, hardworking person, but the product is just not the right one. So a lot of times those are, especially in the early stage, they're not always fully sold on your product. They're more fully sold on you as a person.
It's almost as if it's just basic human needs. We just want someone to agree that they believe in our idea, but they validate with the money and not the market. And that ultimately can lead to failure. Could you walk us through, without naming a company name or anything, maybe the terms in your most recent safe deal, which could be very vanilla, but for somebody listening to this might not know? You can certainly download the safe
Hmm.
document online, um, but walk us through that, and then maybe walk us through terms you've seen in a recent A round, which would involve I'd say a true institutional, more traditional VC firm versus super angels or incubator funds or smaller funds that really aren't, they just don't have the wherewithal to
Hmm.
be an A fund that can do follow-ons and things like that. So let's start with the safe, if that works for you.
Yeah, safes are, generally very simple. Sometimes if you're into the venture capital world and have even a little bit of experience with it, you could probably as a founder pull off a safe financing without any legal help. The Y Combinator form is standard and pretty easy to deal with. Most recent one I had was $1 million raised through safes with a 20% discount on the next round. Um, the the lead angel who put in like $250,000 gets MFN, so most favorable nation, which means if you raise on a safe in the future that has better terms than his, he gets those terms too. Um, there was something that comes in sometimes as a pro rata right. Um, Not didn't happen in this case, but you can also get a pro rata right side letter, which some investors, if you raise money in the next round or through another safe, they get to invest up to their pro rata. They have that right, so you'd have to go to them first before you fill out the round. So that pretty simple with the safes.
Could I
Yeah.
ask a question on that nuance, the most favored nation
Mhm.
for that $250,000 investor? Did the other people, the other 750,000 money, not get that, and only the lead, or did everybody on that safe get most favored nation on another safe?
On this one, it was only the lead. It is a lot of the time, sometimes all of them get it. So you can put it in the side letter or you can put it in the safe itself. So it just really depends on how it's structured, how the founder.
Are side letters problems though for other, and like I'm I'm feeling like God, if that came to fruition on another safe and I had to explain that to the 9 other investors that didn't get that, and then they say, "Well, why didn't you offer it?" My answer is, "Why didn't you ask for it?" And then they say, "Well, you hid something." They could say that,
Yeah,
and now you're in this weird do you see that, or is
it's usually defined by the check size. It's like it's funny. It's like, yeah, you want pro rata, right? Or the most, favored nation. You need to match the check size. It's nothing personal, but there we always do counsel on managing those relationships. So, like I said, maybe some of the terms in these venture financings aren't going super, aggressive in favor of the investors, maybe because this is such a like people's business and people want to uphold their reputations and be good with everyone because you never know where anyone ends up at a new hot startup or the next venture. So um, yeah, so it's important to counsel on those relationships. Make sure, you know, you don't have to disclose everything to everyone. It might come up in the future as long as the founder is aware and can communicate that. But usually it does come down to, hey, this guy's cutting a very large check, a six-figure check. You're cutting 25 or $50,000 check. I can't give this right to everyone. And it comes up in the price round too with the major investor term that you see. If you cut a sizable check, you'll get more rights than everyone else.
well, I'm gonna ask you about that in a second.
Hmm.
Are there any term is there any standard on time in the safe? Meaning, let's say well, to just use that case that you just did, $1,000,000. What happens if they never raise money again? Well, what is the standard term, and are people changing that standard term?
Yeah, that's a good question. There is no deadline or maturity date on the safe, which is how it's different from any type of debt that you may raise. If the safe is never converted, they're basically treated as like an equity holder at the point of liquidation or some sort of exit. So you essentially become senior to the common stock, if I'm remembering correctly, but you're not senior to debt or anything like that, or even any existing preferred stock. I would need to double check this, but that's if my memory serves me correctly, that's how it's handled. Um, does not happen that often, to be honest. If you could raise $1 million in safes, you can hopefully ideally raise a price round in the future, but we'll see what happens. um,
Just so I understand that, if you never raise money, so let's just say you're a small company, you raise $1,000,000, you actually sell for 100. That amount of that 1,000,000
mhm.
of 100 would be 1%. Maybe they get a discount, so it's
Yeah.
at 20%, so it's 1.2%. Is that right? Um,
Mhm.
or they're I think that's right. And that's how it would convert for them at the exit effectively.
Yeah, so whatever the price per share for works out for the $100 million, exit, you would convert to common stock at that 20% discount. So
Oh,
yeah, so
that's different than my math.
yeah, so it's essentially treating the exit like a price round where you get, you know,
So you actually, as a founder, would not want that to happen.
I mean, you're pretty happy with the situation
No,
that just
well,
happened.
I understand. I'm trying to maximize here for take home pay. So,
Yeah, yeah.
um,
So yeah, it just doesn't happen that often. That's why it's kind of hard to do the math in my head right now. But yeah,
right.
you do not see someone raise $1 million safe and then a few years later just get this huge home run exit. I
Well,
haven't
you
seen
hope.
it.
I want that for everyone.
Yeah, definitely.
Everyone to happen. But I just wanted to ask that because I actually do know a Y Combinator company. I'm not going to say who it is because I don't know that I had him on the show and I can't remember if we talked about it on or offline, but he came out of Y Combinator, raised, I think, $90,000 uh, on a safe, which would be the Y Combinator safe.
Mm.
They've never raised money again. They are at least 10 years old, profitable, growing, and it just sort of sits there.
Yeah.
And uh, and that was a case where they decided they didn't want to raise money. They obviously didn't need to because they were growing and profitable, and just didn't need that. I don't even. I'm sure they have a line of credit for for cash flow potential issues, but
Mhm.
yeah, they never did it. So it just hangs out there, and then it would just convert like a priced round, I guess, at that amount of money at that discount.
Yeah, I mean, I've gotten this question too from clients, because some of them aren't sure if their company is, something that can become something like venture-backed IPO or like billion-dollar exit of any type. And I tell them, look, if you just end up becoming a positive cash flow company and that's enough to support you and a small group of employees and things like that, you can always just negotiate to cancel the safes with the investors, give them some sort of return that you feel is fair. And if they agree to it, then that's fine. You could just pay it back with some sort of return and get rid of it, and everyone should be happy. I mean, it's better than losing your investment completely, right?
Of course, I mean, and the investors sort of that's the bet,
Hmm.
right? Don't bet that money if you're an angel investor out there or thinking of being one. Don't bet the money if you can't afford to lose it. It's
Exactly.
in startups. The have you Do you see any term when it does happen? Are there terms that you've seen that an investor can, I mean, a company can buy back or buy out the investor? Is there a dividend on a safe at all, or is it just the discount for the most part?
No, no dividend. It is just a discount for the
It's
most
just
part. Redemption rights or anything like that where the company can buy back, you know, um, either outstanding stock or safes like that. Again, not very popular. Um,
not very popular for the investors.
either or, whether the company wants the right to kind of cancel it by paying back the money or the investor wants the right to have the company buy them, back is very unpopular. I think, again, I'm not a pro or professional, but I think you run into QSBS issues when you're doing redemptions. QSBS is, it's been on the chopping block a couple of times and it's surviving, but
We need that in California.
yeah, so California doesn't recognize it, but for the listeners, it's basically a $10 million exemption from paying capital gains tax on startups that you invest in if you hold on to the stock for over 5 years or the equity. Um,
Any stockholder, though, any
yeah, yeah,
stockholder
and
that's vested
yeah,
5 years,
exactly. Any stockholder.
founders included, which I have the folder right there because I was telling someone about it the other day, and they're like, "That's not true." And I said, "Well, that's a dirty secret that how venture capitalists can operate in California because federally it is $10 million chunks, and in California, I thought Nareg, unless they changed it, you still get some. It's not the full tax rate. They don't, or is it that they don't recognize it at all?
Uh,
I don't remember
I'm not
specifically.
sure exactly. I thought it was they don't recognize it at all, which it made some headlines these last years because of all the people moving to or claiming that they moved to Florida or Texas.
Right.
So California's been going after them to pay their taxes. But yeah, I thought it was they don't recognize it. I'm not sure.
But it's the qualified small business. Uh, what's the
Stock.
last word? Stock
Yeah.
deal, and it's $10 million chunks. Because theoretically, if you made 100, you could divide it up into LLCs and move it and give it to your wife, your kids, and everyone else.
Yeah, I see that. I see that I'm being asked a lot too, and I don't like counseling on QSBS too much
Of course,
just because one, I'm not a tax pro, but also two, um, you never know. 3 years from now, Congress might just completely axe it. It was very close to being done, and it's like if you base all your planning around QSBS, if they get rid of it before you sell the stock, then sorry, like it doesn't apply anymore. So,
but I think it does make sense to think about it in the sense that you got to be and for anybody listening, obviously Narg is a lawyer, but we're not tax people. We're talking about things here that you should do your research and consult your
mhm.
own lawyer or hire Nareg, and then he's under contract to you to give you that advice. But you do have to, you have to be a C corp. You can't be an LLC.
Yeah.
I think S corp doesn't get as much, doesn't get treated as much or at the highest rate as the C corp. So you should think about those things, I think, anyway. And then if you're really that concerned about it, figure out how to. I mean, I had a friend who sold his company and moved to Nevada before it closed. Now, and not from California, from another state
Mm.
that did have high taxes, but even if it was prorated, he still saved. And, if you're that crazy, go figure out what is it, rule 20 and 21 and go to Puerto Rico. I
Yeah.
mean, but figure that
You'd
one
be
out.
surprised how much I get asked about it from day one, from founders too, and I'm like, okay, why don't we worry about making something successful here first before we worry about that? But yeah, there's a ton of estate planning and tax planners who can help you get multiples of that 10 million, like you said, by kind of sharing ownership with
or,
family members and things like that.
or you could go to Puerto Rico. I mean, my friend did it with a company that was, he funded it himself. Oh no, he had angel investors. I think he raised 750,000 and they grew it to $150 million business. He legitimately lived in Puerto Rico, all the legal stuff. But if you're going to do something like that, understand you're not going to game it. You need to be
Mhm.
there half the year plus a day, and you need your stuff moved there.
Yeah.
Like they're going to look at your cell phone. I think there was a guy who played for the Baltimore Orioles who was from California, and they actually checked his cell phone tower
Wow.
of his cell phone. Well, which would give it up in a second,
Yeah.
right? I mean, so I guess my word of warning as a fellow entrepreneur is, understand that you're not going to just game it. It's going to be serious, but try to focus on actually making money
Yeah,
first.
to speak on that generally, I also get so many clients who say, yeah, I know this one person who did it like this with no problems or no issues. And the thing about the IRS or just the law in general is that things, you could do anything you want and it's going to be fine until one day it's not. So, one person, we're seeing that in Web3 and crypto right now. How many companies have been operating for years and now the SEC is knocking on their door? I mean, Coinbase is a public company, you publicly traded, and the SEC gave them a Wells notice like, hey, we're even coming after you now, after you've been operating for 15 years. So it's one day it will likely come back. So it's worth doing it right. Maybe your friend is getting away with it for now and maybe the next 5 years, but maybe in year seven, they come after him or her. So
Well, yeah, I mean, he legitimately followed the law. I'm saying he did it, and it wasn't just simple.
yeah, yeah,
It was a major like move and effort and everything else. And so I have some friends who have moved there and actually live there all the time. And at that point, it's going to be very hard for anybody to say anything. I'll just we'll jump into an example of or maybe we'll talk more about the safe and then move into the A round idea. But I'll just leave people with this thought. Here's what I say. People say, and I'm sure they say it to you, you're in LA in California, and I'm up here in Northern California, Half Moon Bay, and people say, you live in a terrible tax state. It's absolutely ridiculous. And I can't imagine doing that. And my response is this: take advantage of all the tax laws that are on the books that you can. But I look out and go see the sun 250 plus days a year, and I see the ocean, and I will be dead in like 60 years. And I don't think when I am on my deathbed that I am going to be so glad that I spent my time in Nebraska. No offense to people in Nebraska or anywhere else, that I optimized my taxes. I think I'm going to be more excited that I had fresh air, sun, and lived in a place that I wanted to live than I am going to be about taxes. But
I'm with you.
it is painful. It is painful. I will share this with you, Nareg, and listeners, is that my wife was very one way, not one way, but trended more one way on the left. And then we sold our first company, and and we had to pay Uncle Sam at the end of the year. And she's like, "Well, what do you mean?" And I was like, "Man, this is how it works. Like, all this money is going this way." And she's like, "Well, we can't afford the 35-foot RV." I was like, "No, we're gonna have to cut like 5 feet off of that thing. It's going to Uncle Sam." So, it's a real thing. That's a bigger discussion,
Yeah,
but it is smart, I think, to have the discussion, but not to focus on it until you actually like can see that
exactly.
very near, very near term. So going back to the safe, people don't really do the exit. I brought that up to you because in my previous experience, I've had investors that didn't work out, meaning you get divorced. And I wanted to buy the investor out mainly because we just weren't getting along and it was sucking a lot of my time to manage
Hmm.
this investor. And I was like, why don't you just let us buy you out? But he didn't want to buy. We might not have got along, and it was a business. It wasn't that he was a bad person. It just
Yeah,
we fundamentally did not agree on the business, and I didn't want to hear it. So, um, I always thought like, hey, write something in your safe that you could return the money to investors at some dividend rate and redeem, have a redemption thing. But it doesn't sound. Are any of the people that you're working with or have most recently, have they tried that, or is it just not? They're not bringing that up.
it's not really being brought up. I mean, I don't think most of these founders who are raising money through safes ever plan plan for something like that to happen. So it really just comes up later. Um, Mostly when there's an investor that things aren't working out with, they'll exit in a later financing round. So an investor will come in and buy their shares at the higher valuation. So they'll get a return, and so they're sort of happy, and the founders are kind of happy because now the investor has exited and they don't have to deal with them anymore, at least on business terms. Hopefully, still a good personal relationship, but yeah. So that usually happens by Series B, Series C. You'll start seeing secondaries. It's called a secondary sale, where existing investors or even founders get some liquidity from the new investors coming in.
Yeah, I'm glad that you brought that up because I think that's important. Years and years ago, it didn't always happen that way. Everybody was really forced to stay in, but now people are getting some liquidity, and I think that's good for founders to take some risk off the table as they go and they lose control
Yeah.
or lose as much control, right, of their companies. In the safe, do you see any terms at all that that someone has to approve some level of spending over X amount or anything like that?
No, that's still pretty uncommon. That comes in a lot more often with priced rounds where the lead investor will appoint a director to the board, have a right to, and at that point the charter will lay out protective provisions where, let's say, any expense over 100,000 or any debt financing over 100,000 will require that specific director's approval. So along with the board, majority of the board in general, that majority must include either that director or sometimes you need the entire class of preferred stock to approve it as well. So there's different flavors. Obviously, getting just the investor director to approve is a lot easier than going out to the entire class of stockholders, depending on how it's been structured, who holds the majority of the preferred stock. But usually that always comes in a price round. It's mainly because safe investors, a lot of them are angels and either aren't aware of those options or nobody wants to spend the time and money negotiating such a document that's become so standard. So you really just see the Y Combinator standard document being pushed around mostly.
That makes sense, and I appreciate you sharing that. Before I want to ask a question that I had before we move on to getting into A round, which is for founders around the 83B
Mhm.
uh, uh, filing that theoretically you should do if you have stock options. Is that or your stock is going to vest, or does that need to happen regardless if you have stock options or you're vesting?
Yeah, that's a great question. We even at Cooley and even now, we like to tell our clients that 99% of mistakes are fixable. But one thing that's kind of unforgivable is missing your 83B election. It becomes a huge topic of discussion during diligence. The reason being that 83B elections is basically a way of deferring your tax liability with IRS. Um, how it works is if you have a stock option, it does not apply. You do not need to worry about it if you're given a stock option. It only applies to restricted stock. So stock that you're purchasing up front, but it's vesting over a period of time. The reason being is that,
Let's say, can we
yeah,
just, can we, this is really important.
yeah,
I mean, because you just said that you can't turn back time.
exactly.
Uh, so if you, I think your camera might have gone a little bit out of focus,
Yeah, sorry
or
about
it could
that.
just be, yeah, no problem. Um, the if so, let me just give the scenario and you comment on it, and then we'll talk about it
Hmm.
a little bit more. If I start my company and well, you have a standard fee, which is like super fair, and that's a fair plug. And just for listeners, Nareg and I, this is the first time we ever met. We talked online, but I know good rates and I know fairness, and we'll talk about your model a little bit later. But it's super fair. So I get you to stand up my C corp,
Hmm.
register it in Delaware, yada yada. I buy the shares outright. There's no vesting. I I just we issue 1,000 shares. I pay 0.001 cents and I own them.
Yep,
No 83B election is needed with that. Is that correct?
correct.
But if I start it with a group of people and we all own, so 50-50, we each have 50%, but we make the agreement that we get the shares, but those shares only vest over 4 years, and we do that to protect it in case one of us leaves
Mhm.
and then we're stuck with this other partner. That would be called a restricted stock and require the 83B election within, I think, 30 days of buying that stock.
Exactly, that's exactly correct. So you will need to file what is called the 83B election form. Um, they're they're all over the place on the internet. There is no exact right format. Essentially, you're letting the IRS know, hey, I purchased this stock at the fair market value, which is extremely cheap at the time. Um, and so I'm not recognizing any income today, and I will recognize it as capital gains income when I eventually have a disposition in the future. Um, the reason why that's so important is if you do not file the 83B election, as your stock vests, you have a tax liability of the spread between what you paid for it and what that fair market value of the stock is at the time invested. So you can imagine in year three, if your stock is worth $10 a share and you bought it for at par value, which is whatever a tenth of a penny or thousandth of a penny, and you have 1 million shares, it ends up being like a huge tax liability on that year because every month some is vesting. So you do not want to be stuck in that situation because you haven't seen any liquidity from those shares, but you're stuck with this tax bill. You're gonna have a tough time finding the money to pay for it, basically. So there's no reason to be stuck with that. And a lot of times when people miss their 83B election, they have no idea that's how it works. So you are basically delinquent on your taxes if you haven't been paying it, which comes with penalties and can end up being like this huge financial burden on you and the company. So it's always a diligence issue whenever you have a priced round and investors council is looking through the company's documents.
Along with that, there's must be, I'm teeing it up for you, another agreement that is a restricted stock agreement that spells out what the vesting is. Is that true?
Um,
So how I mean, is it just a verbal agreement? So I found the company with my partner.
mhm.
We agree it's a 4-year vesting schedule. That makes it restricted
Yeah.
stock. But is there another document that says the restricted stock vests over four
Oh,
years?
yeah. So the board will formally have to approve it, but also your common stock purchase agreement will spell that out. So you will have to sign a common stock purchase agreement. You should send a check for it's going to be a nominal amount if you're a founder, 5, $10, something like that, maybe 50 or $100, to the company to purchase your shares, and it will spell out, you know, 12/48 of my shares will vest upon the 1 year anniversary of the vesting commencement date. Thereafter, 1/48 of the shares will vest each month on the same day of the month as the vesting commencement date, as subject to your continuous service. I've done it so many times, basically memorized the, as long as you're with the company, it will continue vesting.
Um, but not sometimes the company is founded when you're going to get an investment because it was really run as a project or something. But in other cases, founders might not be in as much trouble because they could have incorporated. Their stock is common. They're not retired. They're not required the 83B election.
Hmm.
A new investor comes in and says, well, that's great, but we're going to change the terms. Now that stock has to vest, become restricted
Yeah.
stock and revest. So they will get a chance to file that 83B election at that point.
Yep, exactly. So we see that a lot. A lot of founders will want their stock fully vested when they incorporate the company. And then, like you said, in a price round, the investor will say, hey, we want 50% of the stock to vest over 4 years from the day we close our investment. So then you'll enter into a stock restriction agreement. And at that point, you tell the IRS, like, hey, I entered the stock restriction. It's 83B form, a little bit tweaked just to explain the situation to the IRS, and you're good to go after that.
Well, I appreciate you covering this because this can be a major situation where you're not even buying those shares, you're just vesting them, and all of a sudden you have tax consequences that you don't even have cash to pay for. What happens in those situations?
Uh, there's some creative options. Nothing will fully get rid of that risk for you, the IRS knocking on your door and asking for that money. Um, but yeah, it's very dependent on the context and the situation. And they really didn't do much with the company over that 2 years. It was like a side project, and they, didn't file an 83B election. At something like that, it's kind of worth anything at this point. So it really depends on the situation. So yeah, definitely hire some legal counsel or maybe a tax professional help you if you find yourself in that situation.
I mean, it's sort of a catch
For
22
sure.
because at one point you don't want to vest because you just want your shares outright. And the other, I think if you have a partner, you want it
Mhm.
to
Yeah,
to vest to
the
protect
advice I
both of
give
you.
is,
But if it's
hey, it
just
might be
you
better
and you don't have an
to
investor,
determine
you might
your
as well
vesting
just
schedule for yourself at
buy
the
the
very
stock outright,
beginning,
and then it's just capital gains
because you're going to have to
at that
negotiate it with
long-term
the
capital gains
investor
tax at
during the
that point,
price
right?
round. And it's just another thing that you're going to have to figure out in that term sheet that might slow things down. And a lot of times when the investor sees, oh, he started vesting a year ago on this date and has a 4 year schedule, they'll kind of back off. The this guy really thought about it. He had advisors or counsel help him figure this out. It's good enough for me. Let's just go with it. But when it's not, there is no vesting, they'll try to push terms that are more favorable to them. Hey, I want you to start vesting today, like no stock as of today, no matter how long you've been working on it. So you might see some of that. You might see 25% upfront, the rest vest over 4 years instead of 3 years. So if you wanna enter those negotiations, it's kind of up to you. But I kind of like having my founders decide for themselves at the beginning and impose that on the VCs rather than reverse. Mhm.
It's
Yeah,
good advice.
blue sky
Are there
filings, I
any other
think
documents
almost
besides?
nobody
I
thinks
just
about.
want
I
to cover
think
the
it's missed
83B because
by
it's so
like
important.
Stripe
Most of
Atlas
the
and the
other stuff
Clerkies of
is
the world
fixable
too,
through
where
amendments and things like
type
that.
if you
Not that you
don't
want to
want to do
do
that
that,
because it's more
memorialize it, or clean
expensive
it
and
up,
they're
but can
publicly
be cleaned
filed,
up.
you'll have to comply with each state's securities laws that you're in. So California is a popular one where founders live in. There's something called 25102F
What
and
is that?
25102O filings. Um, those are kind of required once you issue stock to anyone or you reserve stock for an equity incentive plan, a pool for your employees and advisors. So those are missed. Foreign qualifications. So if you file a Delaware C Corp and you're living and doing business in California, you'll want to qualify to do business in California. These things are missed all the time and usually don't have major consequences. So it's not as scary as an 83B, but you might be hit with like a small penalty here and there. And it just, why suffer through that? Just you have counsel that'll help you figure that out for you. Working on it right now. It's kind of like in between that range. Um, 1X, non-participating liquidation preference, which is nice. Um, no pay-to-play provisions. Usually that comes in later on. I can kind of speak to that. Active provisions, um, a blocker on that's pretty, significant in my opinion. Budgets and talking about it, which just goes to
That's
show
good
because of the
advice.
now on the
And I
look at it
appreciate you
as soon
covering
as the
that.
quarter ends, get going on
Let's
those
jump
statements
over
so I
to
know
your
where you
most
guys are at.
recent A
Um,
round. Let's A priced round, not a bridge, which, well,
that,
I don't know if
with
people count
regards
those as rounds as any
to
or not, but let's just say a priced traditional A round. What terms are you seeing now? Anything on the spend amount? Well, in general, it seems fair. I don't like having to always get approval on raising money, which it sounds like they basically control because you would increase the pool, and that can cause problems down the line if something happens. But at some point, people are giving you a lot of money and it's at risk. Is this company have revenue? Yeah, I don't disagree. I don't disagree at all. I mainly did it one because I can afford to do it, and I withstood 2 decades of pain to be able to be my own venture fund. Um, and two is I do understand from the past, and I don't think this. I think what you just said is very important. There's a distinction between angel investors and venture capital. Not that money isn't equal, it's the institution of the VC with having LPs that as soon as you take that money, you really are under a time clock. And they're under a time clock. I mean, it's an IRR time clock. I mean, it's pretty simple math. But I think in the early stages, I have found that you have so much going on. You are, at the end of the day, you're never going to get done what needed to get done ever. And to add on investor management on top of that creates extra stress that and time that just like is not best for the business. And I understand, like, hey, it's a luxury to do this. Having said that, my first company, it's over 20 years ago, I traded stocks to fund it so that I didn't know I didn't know any different. I'm not recommending it. I'm just telling you that that is the reality. And it worked. And, that was, I didn't have to negotiate. All I had to do back then was watch CNBC and make some bets and sort of react on emotion, and it worked. But I think that that's the reason for that people need to understand. And, the trying to you spend so much time convincing an investor on your idea, and in the early stages you have to pivot. I hate that word, but change direction. You got to retell a whole story, and that's hard. Yeah, and your your diligence is going to be super painful if you don't. One thing, and maybe you could back me up on this, that I found, and I made the mistake before. And I'll be honest, Cooley. I've been working with Cooley and Mike Lincoln for 20 years, literally. Um, Build your diligence corporate book in a binder with holes, with all of your corporate documents, so that when you raise money, you can hand it over and you're not digging around for all those things, because just having that, one, will show maturity in my experience. And two is, there's so many things happening with all of these documents and contracts and employee agreements, and which maybe you represent entrepreneur side of the investment. Like, I think all entrepreneurs should have a employment agreement when they take professional money, which maybe you could comment on. But you got to have that diligence book. And if you can hand that over with your corporate charter, all, whatever, if you have a restricted stock agreement, whatever it is, all these things, um, it is going to make your life easier for everybody. What's the general pool going focusing on this A round that we're talking about? Was it a 15% stock option pool that needed to be created, adjusted, and kept? That's what I was just about to say. Do yourself a favor, create the pool for yourself, so that because the founders are going to take the dilution. I mean, and or your seed investors may also wind up taking that dilution. But you might as well, if you're going to go down the venture route, you might as well create it, because it's going to be created for you, and they are not going to take dilution to create that for you, right? I agree with that. Founders should have employee agreements. You agree with that? One last question, and then I want to talk about Decrypt and your model, which may have changed the venture lawyer model pretty significantly, is the advisors. You hear a lot of people, you see decks, they put advisors on there. There's pretty standard vanilla documents out there, what you should give advisors based on your stages. You can just Google that. I can put that in the show notes for people. But do you think that is really worth investing in having these advisors and putting them forward? Are investors really taking them serious as if they are contributing greatly? You just see a lot of early stage founders have, 15 advisors on their slide, and you know in my experience it's a lot of work to run an advisory staff, an advisory board, in a way that delivers value to the company truly, versus, and I don't know, I guess, tell me, does it hold any real credibility with investors, especially the A round investors, that this really matters? I think that's a good point, and I appreciate you commenting. I'm probably a little bit over it, mainly on the tech side, but I think your point is really made me think, like, in a life sciences business, having PhDs and people like that for a drug or whatever, that a device probably matters a lot. But like you said, in a web 3.0 thing or something, and you're like, really? Like, my first question is, how are you running your advisory committee? Because I know I didn't run mine. It just like I got 50 other things to do, and I just can't even barely keep my board organized, much less that. So I appreciate you adding some color to that. Did we miss anything, Nareg? I mean, we covered a lot. I'm really grateful for you sort of giving, this is a fire hose for some people, but also for some other people out there, just some insight into what's happening in the market today, which, to be really honest, you hear some drama out there and some, oh, it's not, it's hard, it's not as good. It's not terrible. I didn't hear you say 2x participating preferred in there, and in fact said that it's not in there. So life is not terrible right now. I think it's one of the best times to actually start a company. I've started all my companies, major companies. I've failed. I say failed. I've tried like 25 times and not projects that didn't work. But the ones that have seemed to come out, they come out of the dot-com crash of 2000, 1999. Well, it was really 2000, 2001, out of 2008. And I started one. I purposely started one in what some arguably consider a recession or a bump in the road here of what I don't know what this is, but it's definitely not as fast as it was the last 3 or 4 years, um, because you're at zero and it's all upside. So, um, did we miss anything else? Yeah, thank you for saying that because it just it's a there's a lot of bad information out there, and and respectfully, there's some unsophisticated investors out there, and God bless them. Like you got to get out there and you got to try, and the name of the game being an investor is deal flow. Period. Like no deal flow. Um, for entrepreneurs, I always say, Nareg, don't forget that we are the professional investor's product. Like that, don't mistake that, ever, no matter what anybody says. So I think that's a great word of warning. I want to talk about you worked at, I mean, you came out of a great place, UCLA. You go to Cooley, which is a top firm that no one will argue with. You probably seen so many deals just in your time at Cooley. And then you ventured out on your own. You actually are an entrepreneur. You sort of changed the model. You have a flat fee monthly rate, I think is $750, which is an incredible deal to basically have in-house counsel. You have flat rates for not just uh, entity creation, but a safe. I thought was, I don't know, $1,500 or something, which is like ridiculous. Sure, you could download it on your own. You could do a lot of this stuff on your own. The question is, do you want to do it on your own, or do you want to pay a little bit money? And if my argument always is, if you think your company is worth that much money, like 15 few $1,000s, are we really arguing about that or even thinking about that? Um, I understand what it's like to have no money. Trust me. I grew up eating, my first company, my wife and I were just trying to make the mortgage and I was eating tuna fish sandwiches, literally, sometimes not even with bread. So I get it. I get it. But these mistakes that you could miss, like an 83B or just some other things out there, could in the end cost you more money. What made you decide to do that? I totally agree, and I love the flat fee. I don't know how you manage. Do you manage that by some maximum time that people can call you, or is it sort of a free flow discussion? Well, I agree with you. I remember walking into my first lawyer was Harry Glazier of GT Greenberg Traurig in Northern Virginia, who really was the first big law firm practice at that time to go in, at least in Northern Virginia, to be in that space until Cooley came in there. And I remember Harry, my first time, he's like, "Look at our new office. Like this place is awesome." And I was like, "This is Harry. This the only thing this says to me is I'm paying you too much money." You're talking to a founder who's, you know, living at 1,400 square foot house trying to make his mortgage with his wife and eating tuna fish sandwiches. Like, I don't care about your beanbag chairs. But so I think your model is good. And I think, we live in a time now that's what founders are doing. Founders aren't getting offices and if you I'm not saying that in person isn't good. I'm just saying that remote teams work and it's sort of become much more common than it was even 10 years ago. So I love that model. And I appreciate you sharing that. And I wish you the best of luck with it. If you were to leave founders listening to this, entrepreneurs out there who may want to raise money with just 3 tips, whether that's deal terms, general advice, stuff we've already covered, what would be your 3 HPTs, high percentage tips? Those are great 3 tips, and they're absolutely spot on. So thanks for sharing those. And it's always hard to come up with just 3, but those are great ones for listeners to follow. Where can people listening find you and your law firm? Well, that's awesome. We'll put that in the show notes. Listen, Narg, thank you so much for taking time out of your day to share all this information. I could talk to you for a whole bunch of hours. We'll probably have you back on maybe in a few months, give us another update on how things are going, and who knows what's going to happen with the economy. But as the economy, quote unquote, comes back and the bulls start running, we'll probably see some changes and some money flowing in that's been sitting on the sidelines. So thanks again for taking time out of your day. Yeah, time flies when you're having fun. Thanks a lot, man. Bye, everyone.